Today on security analysis and portfolio management, we are on the ninth unit, valuation of securities. Now, before that, we have gone through everything. The first phase, we did economy, industry, company, and etc. And now, after that, we did yesterday the technical analysis, and now we are doing the valuation of securities. Now, it's very important to tell you at this moment the market, everybody enters to make some extra money. I mean, the price you will enter, you expect that you should be getting more than that. But people forget the very important criteria here is that at what price you are entering the market. So your buying price is also very important. People, there are many school of thoughts. They say you don't make money by selling the share. You make money by buying the share. At what time you bought the share. That is why you got, yesterday I have shown the technical analysis, the ups and downs and etc. You could get that up. So this is why it is very important. A lot of people ignore. They look at the price of the market and they say, okay, at this price I'll buy another thing. Whether that is the right price to buy or not, that's very important. So today we'll try to understand the valuation of securities and understand the pricing. So to introduce, valuation of securities is the process of determining intrinsic value. Note that we are not talking about market value, we are not talking about any other value. Intrinsic value मानेगा मूल उसका जो price होना चाहिए, intrinsic value of a financial instrument such as share, bonds, derivatives. As I told you, these are called financial asset or financial instruments to make informed investment decision. And here I will take a pause and I'll tell you, even if you take an informed investment decision, because market moves in market's way, even after making informed investment decision, you may go wrong. And for that, yesterday we have discussed that you should have a stop loss so that you do not lose your total capital. Now, the next parameter, I defined the intrinsic value. Intrinsic value of a security much less than a market price. If intrinsic value of a security is much less than the market price, the security is said to be overvalued security. Now, current market price is CMP, IV is intrinsic value, MP is market price. It may not be worth buying at that price. I'll stop here and explain you with a simple explain. Suppose you are going to buy a second-hand scooter and you find that second-hand scooter is in the garage. You value it, it should not be priced more than 30,000. But the garage owner says it is 45,000. So garage owner is giving you market price and you are valuing it at 30,000. So now you think the market price is pretty high than the value of the two-wheeler. So obviously you will not buy or you will bargain. And in all probability you will not buy if he doesn't agree to you and you come back. In share market also exactly for various reasons some share prices or other financial assets, say bond derivatives, are highly priced for various reasons. But you should do your own study and take an investment decision whether it is worth buying at that price or not. The alternate is, if you find something is very low priced में available है but उसका intrinsic value is good, you must buy it off. You go to the village, you get a dokra or some handicraft which they are selling at a throwaway price. You stay in Delhi or Bombay and you know if you come and show it in your display or sell, you get a high price. That means for you the value is quite high, but for the person in the village who is making it, for him, he cannot get that price. So this is the simple way to understand the difference between intrinsic value and price. Price is known to everybody. But value is your understanding of the product, be it share, bond, equity, any product for that matter in your life. So you must know how to value a thing, right? By understanding the true worth of a security, investors can identify buying and selling opportunities of a security and make valuation of securities decision that align with their investment objective and risk tolerance. Why I have done risk tolerance and investment objective? Yeah, suppose your investment objective is to get out fast, or not investing for a long time, and your risk tolerance is not so high, then you will not buy the type of share which perhaps somebody who is going for a long term and he wants to buy a long term share. Am I clear? Suppose your risk tolerance is high, all high, and you want to buy something for the short term, then you can take accordingly a decision that, well, this is the time when the Diwali is coming, this price may go up, it may not go up, so you lose a lot also. So your risk tolerance is high, so you, but if it goes high, it will go very high, so you invest there. So this is what is the third paragraph is all about. By understanding the true worth of a security, investor can identify buying and selling opportunity and make valuation. Now this true worth, the true worth is as you see it. Every person has a different, and that keeps the market moving. For every person, the true worth of Tata Steel will be different. I mean, individually or a group of people. If not, then the price will not move. Some other person may think, no, this is not the true worth, price should go down. They will sell. Other people will think, no, the price should go up, they will buy. And that keeps the market moving up and down. The volatility is there. And if there is no volatility, there is no point in the market. There are several methods that can be used to value securities. Each method has its strength and weakness. The choice of method will depend on the nature of security being valued and the purpose of the analysis. Why the purpose of the analysis? Why the purpose of the analysis? Maybe you are looking for a short term investment, mid term, or long term. What type of security you should go for? Right? I'm not supposed to quote, but I'm giving you a telling. Suppose somebody wants to go for short term, HDFC Bank is not the right security for him. So there is no point in wasting time in HDFC Securities, HDFC Bank. You should look for other security and then analyze it. Am I clear? And let me go to the next. I hope I'm clear. I'm going to the next one. This is a very, just you go through it once. This is a very important concept in your life. If you don't understand this, you will make a mess of your personal finance as well as corporate finance. Now, time value of money is based on the concept of opportunity cost, which is the idea that the cost of using money is the opportunity to earn a return on that money. You have 100 rupees. You can invest in a bank or somewhere and you can earn money. But if you keep it in your drawer, you lose for that time when it was inside the drawer. So the concept of time value money is very important. Like people say, आज का 100 रुपया after 100, after say 7 years, 10 years, what will be the value of it? Sometimes they think of inflation because the price of the things go up Yes, that's also another reason. But also another reason is that this 100 rupees you are not invested in the right way. Otherwise, it would have increased in value, and the value of the subji and other thing, you could have purchased the same thing, right? So I'll come back to this if I get time. So if you have 100 and you keep it in the bank, you will earn 10%, say. That is the rate bank is offering per annum. But banks generally offer in quarterly interval. But I am assuming per annum interest is there. So after 1 year, you will get, after 1 year, hello, after 1 year you will get your, sorry, after 1 year you will get, after 1 year you will get 100 rupees and 100 plus 10% of 100. That is 110 or 110. Now, in formula, I can write it 100 into 1 plus r. If I take 100, it will be 100 into 1 plus r, because 10 by divided by 100, it will be 10%. So r it will be. Are you clear? If you are not clear, let me just mention. Something again wrong. I'm sorry. Some of the pen drive is not working. Uh, Time value of money. So 100, and if you take out 100 from here, suppose this is the equation, you take 100 out, then what is inside the bracket? 1 plus 10, this 10 is nothing but percentage r, so 1 plus r, 100 into 1 plus r. Second year mein 100 into 1 plus is your main capital. The same capital is getting a return of r into r. So if I take 100 plus 1 plus r common, take it out, I will get 1 plus r, and 1 plus into 1 plus r will be square. So I hope you have understood. You can go through it once again. 100 and 1 plus r, this is my principal. This is the principal on which I will get r. Now I am taking the principal out, so 1 is there plus r will be the residual. So 100 into 1 plus r principal into 1 plus r is the interest component addition. So 100 into 1 r to the power 2. So second year mein we are getting to the power 2. So now if I put it into the formula, what I get is that, putting in formula I get is that future value. Now, this is the future value of your 100 which is in your pocket now. Is present value plus 1 plus r to the power n. This should be to the power n. Okay, this is not multiplier n, this is to the power n. And if any periodic payment are made, future value will be like this: PV into 1 plus r to the power n plus PMT plus 1 per r to the power n minus 1 divided by r. This is the formula. You will get in your handout this way you can get the yield to maturity of a periodic payment. Why yield to maturity? Because we are assuming that after a period T, you will be ultimately withdrawing the whole money, not in between something. You are contributing in between. So this PMT is a contribution in between. But future value at a given time, that time frame you are not changing. So this is the concept of time value. Unfortunately, this is not working. Uh, just a minute, let me see, because it doesn't work today. I will have problem. So now let me move to the next one. A basic valuation model. Now, given a risk-adjusted discounted rate, sometimes it is called RADR, the future expected earning flow of a security in the form of interest, dividend earning, or cash flow, whatever it is. Suppose you are earning interest from the debenture, or you are earning dividend from preference shares, or you are getting cash flow in a business. You can always determine the present value as follows. Cash flow first year divided by 1 plus R. There should have been a bracket. Cash flow 2, 1 plus R to the power 2. This is all to the power 2. Second year to the power 2. Third year to the power 3. Fourth year to the power 4. And nth year to the power nth. Where PV is equal to present value, cash flow is, it can be interest, dividend, or any way you are earning. The cash is coming, cash flow belongs to you. And R is risk adjusted return. There are many other things of it. Sometimes R is called opportunity cost, sometimes R is called interest rate. It depends on what purpose you are using it. Okay, it can be called discount rate, it can be called risk adjusted discounting rate. There are different method of finding this risk adjusted rate, but the main issue is that R is the interest rate or required rate by you. So it can be opportunity cost, it can be your desired cost, it can be cost of capital, that is what you want to recover. It can be the return you want to get from all these cash flows, and etc. So this R has many okay. Uh, so this R has many dimensions. Depending on when you what you are trying to see, the R will be defined accordingly. Suppose I want to recover my cost of capital. Cost, sorry, cost of capital. So I have to calculate the cost of capital, and I have to, that will be the R at that time, and use that figure here. Now the question is that also this is a hurdle rate. Suppose opportunity cost. Suppose bank mein I was getting 7%. So maybe 7% my opportunity cost. So if somebody takes money from me and say he will return it at the rate of this, like that, I'll check the return and I'll see at least I'm getting 7%. He is a very confident person of mine. So at least I'm getting back my money at the return I would have got it from the bank. और यू कैन थिंक ऑफ नो, बैंक में हमको सॉरी बैंक में हमको 7% मिलता है, बैंक में हमको 7% मिलता है. आई विल गेट सॉरी बैंक में हमको 7% मिलता है. सम अलाइनमेंट प्रॉब्लम. 7% मिलता है. आई विल गेट 9%. So in that case, R will be 9. I hope you are clear. I have made it clear. Let me go to the time value of money also. Here also you have all the n or whatever I have written in here. These are all multiples. 1 plus R to the power n. I was going to show you. See, suppose 100 is your deposit, and plus 100 into 10% you are earning. Now suppose you want to do a little bit of mathematics. Then this 1 plus 10, this 10 is nothing but your R. That is what is put here. That is what is put here, 1 plus R. So that is put here 1 plus R. Okay. So now let me go to the next one. Introduction, I have given time value of money. This is the concept. You have to work on it. Then you will have more confidence. This is very important concept because many time we are investing some money, SIP. A lot of people invite the mutual fund. You do SIP. So you put in money and finally you get a lump sum. So you must know what will be the present value of the lump sum. Let us do a small thing. I'll do it at the end of the provided I can manage time. So now next is basic value valuation model. So that means the present value, and if you reverse it, you will get the future value. The valuation of bonds. The bonds are debt securities issued by government and quasi-government organizations. Government organizations, what they issue this is called GSEC. It is called GSEC, government securities. Now, government securities are generally what central government, issues, that is called what central government is issuing, that is called, what is central government is issuing is called that is called what central government is issuing, that is called government of Indian securities. State government also, that is also, those are also GSEC, but has a little risk unless it's governed by issued by RBI or backed by RBI. Then quasi-government organizations are like NABARD or some of these not public sector undertaking. Okay, and when they issue the SIDBI, they issue bonds. Those are quasi government issue. National Highway Authority of India, they issue bond. Exim India, that is Export Import Bank of India, they issue. Those are the quasi government organization. Private business firms and there are public sector undertakings, those bonds. Okay, but never have a mistake that these bonds are guaranteed by Government of India. Technically, government may come and save the bonds, but that is the expectation you are having. Legally, it is not. Private business firms are all these debt securities. Their are called fixed income securities because generally you get fixed income out of these investments. Of course, there are floating rate securities also, but we mostly discuss now here on fixed income securities. The intrinsic value of a bond is just a minute. Okay. Okay. Now, the formula for calculating the present value of the bond, intrinsic value of bond or debenture is equal to the present value of expected cash flow. Now, naturally, suppose you want to invest 10,000 and somebody says, I will give you 1,000, 1,000, 1,000, 1,000, 1,000, and finally you get 10,000. So I have to calculate depending on my expectations that ultimately I am getting my present value or not. That is a situation. That means if I am giving somebody 10,000, and sorry, I'm giving somebody 10,000 and he is returning 1,000, 1,000, 1,000 karke, the money is I am getting, earning, but finally it's giving 10,000. So if my expected return is 10% only, I will see that I will get 10%. I will show you now. So Let us see here. This is the prime present value of bond formula. Now, if it is present value of bond formula, the future value will be the reverse of it. We'll do it later on. The present value of bond, if I get time, C is the coupon payment, coupon is the interest rate. R is the discount rate. Now, I have told earlier, discount rate can be your opportunity cost, your hurdle rate, that means this is the minimum you want to get. This can be your cost of capital which you want to recover. This can be your required rate of return. Okay, so all these things you have to define what is R for you. But basically, this is the rate at which you will be discounting. Rates will depend on how you define it. N is number of period, usually years. There are many tables that are available in back of security analysis books or financial management books in which tables are there. Present value of one, future value of one, or annuity can be present value and future value. These tables are there. So please go and check once if you are seriously studying this subject. Now, discount rate used to value a bond depend on the bond's risk. Now, why discount rate used to value a bond depends on the bond's risk? Now, suppose I am investing, let us take for example, you are investing something into the domestic house, residential housing project. Okay, so rental, everything is rental. So it will be occupied by the people and you will be earning your rent regularly. Middle class, affordable renting housing project. And I am doing the same. I am also doing construction, but I am doing a mall with the inox and everything. Now you know that in mall and inox may to fill it up and inox way to get a regular flow of traffic may be difficult. Maybe if it is COVID or something like that, or some 7 days there is a problem or the festival, people may not come to the market. But rent at the end of the month or at the beginning of the month, everybody will pay. So one stream of cash flow is very sure for me. But the Inox or the mall wala cash flow is not very sure of me. So there is a risk profile. If I issue bond to construct both A and B, both the bond will carry different type of risk. So my discounting rate will change. My expected return from a residential property will be maybe 12%, 13%. But my expected return from the Inox or come mall may be 24%, 23%, 18%. It depends on what type of return you are getting in similar industry. So that is why this line in bold, discount rate used to value a bond depends on the bond's risk. Understand it? Then you proceed. Now consider a bond A. So we are moving to the next phase. With a face value of 1000 was issued for 5 years, is issued for 5 years. I should correct it. At par, that means you have to give 1000 only, with a coupon rate of 10%. That means interest rate is 10%. Interest is paid annually and the bond is newly issued. As I told you, it is a fresh issue. The value of bond would be as follows. Now, it is freshly issued. So 1 by 10, your expectation, you are applying 10% interest rate. So your expected return is 10% only. So your discounting rate is 10% only. So 10% you will discount, you will get 100, you will get 100, you will get everything. Okay, you will get 100, you will get 100 to the power 2, to the power 3, to the power 4, to the power 5. And finally, when you're getting your, it will not be 1100, it will be 1000. You're getting your principal back. Then also it will be to the power 5. Now, if you check a present value of a future sum, PBF, then you will get these figures. 1 year में इतना, 2 year में इतना, 3 year में इतना. I have multiplied it, and 1100 I have kept. I have removed that 5, so you will get this 999.97 or 1000 roughly. So that means 10% return you are getting in this bond if they regularly pay you the interest as they promised for 5 years. Clear? This is a simple understanding for you. Now let me move to the next issue. Suppose I get another bond in the market which is offering 6% with a face value of 1000, otherwise same, issued 5 years ago. It is a 10 years bond, so 5 years is remaining. Annual cash flow will be 60 rupees because 6%. 5 years is the maturity of the bond. Like my earlier bond, here I had, it is a 5 years bond. It was a 5 year bond. This bond is also similar. It is 5 years residual life. So I will be getting 60 rupees for 1000 rupees if I invest 1000 rupees. So I will not get the right money. So I will not pay 1000 rupees for this bond. The question is how much I will pay. So what I will be getting 60 rupees, and I will divide it by 1 plus 0.10. This bracket is missing. 1 plus 0.10. Similarly, second year I will get 1.10 to the power 2. Third year I will get 1 plus 1 plus over 3. Fourth year 4. Fifth year this, and principal. Here I have written 1000. You will get the principal back. Again, you have to discount it 1 plus 0.10 to the power 5. So if I multiply everything, you will get 847.35. So investor will buy the bond at 847.35, and because only then he will get a return of 7.08%. You get my point? That is called current yield. That is current cash flow divided by market price. So you learn something about current yield. If I buy a bond from the market at lower price, then the lower price, if I divide by the cash flow is divided by the lower price, I get a yield which is called current yield. But I am interested in a yield to maturity of 10%. If I hold it till 10 years, I will get 10% yield to maturity. How? Now this 847 minus 10,000, 1,000, that is 150 plus, I am getting over the 5 years. You get my point? I am getting over the 5 years. So that means 1.50, there is a little mistake here, 6830. It should have been 6209. So all these things, if I add, I will be getting 1000. My desired return of 10%. So this is called yield to maturity, and this is called current yield. Current yield is the, if I buy a bond at this rate and I divide it with the interest I'll be getting the current yield every year, 7%, which is more than 6%. And at the end of the year, I will get 1000. I have invested 847, I'll get 1000. So that difference actually will make your yield to maturity 10%. So valuation of bond, current yield and yield to maturity is this thing. And here you also learn two things, current yield and yield to maturity. Now preference shares. Preference shares are somehow a hybrid, somehow it is a hybrid securities. To some extent, it behaves like a bond and then it becomes a share. or it may not become a share. They have some features of bonds and some of equity. Theoretically, preference shares are considered a perpetual security, but there are convertible, cumulative convertible, callable. That means I can cancel, I can say, okay, I'm giving you money, return the principal, the preference shares, or redeemable. After 5 years, I will redeem the bonds, yeah, preference shares. Like bond, 5 years preference shares, 100 rupees each. You will be assured a dividend of say, 7%, provided company earns profit. What ordinary shareholders will get, that is different. You are assured 7% if company earns profit. If company does not earn profit, in that case, sometimes it is cumulative. So that's called cumulative bonds. So preferred dividends are specified like bonds. This has to be done because they rank prior to equity share for dividends. As I told you just now, 7% dividend you will get before the dividend is paid to the shareholders. Like interest is to be paid to the bondholders first before I come to the profit. Similarly, preference share will be getting the dividend before the dividend is given to the shareholders. Several preference share issues are cumulative, where dividend accumulate over time. That means, suppose I am starting a new company, first year, second year, third year, I am not earning profit, but I have raised the money promising 7% dividend per annum. So 7%, 7%, 7%, 21% is accumulated dividend. So when the company starts giving dividend, company has to clear these accumulated dividend first, and then company will pay the regular dividend to the regular shareholders. Preferred shares are types of equity shares that generally pay a fixed dividend to shareholders and have a preference over common shares in terms of dividend and liquidation preference. This line is something repetitive. They are getting dividend, a fixed dividend. Okay, it is written there, it's shareholders, I have told you already. And it is a preference over the common shareholders. Before I give it to the common shareholders, I give the dividend to them. And if everything goes for liquidation, the company, the creditor, the loan provider, the secured debtors, the unsecured debtors, all they get money. Now, whatever money is remaining, first you have to pay to the shareholder, preference shareholder. उसका बाद अगर कुछ there is something residue, that only the shareholders will get. This is the characteristic of preference shareholder. So preference shareholder the characteristic is to some extent it is some extent it is like bond where it is fixed, and when it is not fixed, it will uh, converted into equity or it is redeemed. So if I am preference share pays an annual dividend of 2 and required rate of return is 8%, your required rate of return of 8%. Suppose this preference share which has promised 2% and after 5 years or 10 years or perpetually, they will be returning it or not returning it. But you as an investor, you are looking for 8% return. Then what will happen is that here it is written there is no expected growth in dividend also naturally because preference shares may growth is dividend is fixed. The present value of the preference shares will be PV 2 divided by your required rate minus there is no growth. Generally, the formula is today is not working. Please listen. The formula is cash flow divided by the required return R minus G, the growth. The here growth is 0. So 0.08 is the required return, 8% is 0.08. So the value is 25. The preference share will be valued 25 in the current market price. Okay. So 25 into 8% you will get 2 rupees. People may choose it because of the tax-free nature of it. Dividend. Sometimes these preference dividends are tax-free. So what we have learned here, I am not repeating it because here also it's the same thing. If I get dividend, if I get dividend, so dividend will be like 60, 60, 60, 60. I'm sorry. Let me go to this. Suppose I have invested 1000 rupees in one preference shares and they have promised for 5 years, 10% dividend they will be giving it. So this will be my return. 10% I'll be getting it. But if the same preference shares I buy from the market and at a discounted value, then my yield will be going up. So I have to look for 847 price like this. So preference share behaves very much like bond because it is characteristic is like bond. That is how the valuation of preference shares and valuation of bond is quite something similar, excluding one part which when we do share we'll explain that when it is converted into a preference shares, converted into a share, then the value of share is your take home. Then the value of share is your take home. So in this case, suppose I have done it and then the value, suppose 1100, 1000 shares, 1000 shares, 1000 shares, face value 10, that meant 100 shares you are supposed to get, but this 100 shares you 10 face value shares are you are getting 25 rupees market price. That means 25 into 100, 2500 you will be getting. Suppose you sell at that moment. So 2500 करने से जो पीवी आता है, that will be your PV. That will be a great gain. That will be much more than 1000. I'm sorry because of the red pin pad is not working. We are unable to show it. But I am sure if you go through it properly, you can understand. This is something wrong, and in this is also it is wrong. This. Okay, so please adjust for this. The valuation of preference shares is also like this, and if it is a perpetual, it is growth rate is something different, etc. Now let me try to find out the valuation of equity. Now there are various methods: price to earning ratio, price to book ratio, discounted cash flow ratio, which is one of the most toughest and very intricate, then dividend discount model, then comparable company analysis. I will touch some and price of earning. Price to book value is, suppose a company's book value is 80 rupees per share. Now, similar company, similar cement company, if it is being sold at the book value, then it should also have a book value of similar capacity. But suppose that company's book value, because they have retained reserves, they have a lot of money in them, and their asset value they have increased, so the book value will go up. So they will dictate a better price in the market. Sometimes price to book value is used in case of NBFC, non-banking finance companies or banks, because banks and other things जो loan and other things देता है, that is their books में assets. So this asset value देके we value the bank, and then we see it with the price. That is why price to book value is a very good way to value banks. Of course, price to earning is there, discounted cash flow is there, dividend discount model. Generally, people don't do it, but it is a very valid model, and there is a garden growth model also is there. if the and I'll come to the dividend discount model, different types of models. And then there is comparable company analysis. This approach compares a company's valuation multiples such as P, PB ratios. What happens is that here, suppose you get two companies. I'll explain it in a separate way also. Suppose you get two companies or three companies. All are manufacturing paints, I'd say ice cream. Okay. Now, if all are making the same type of ice cream and selling in the same way, then the price of the ice cream companies should also be the same. If they're making the same taste, I mean, 10 taste का सब कोई बनाता है. So I will try to see if I don't know the fourth company. Okay. So I'll try to find out the fourth companies, how many brands they are making. Okay. Then what is the price they are selling? It is the same price they are selling or not. If the same market they are selling or not. If they're selling in a large market, things are different. But if they're selling in the same market, it's the same. So if these three, the first three, are selling the value of the company is around 10 crores, then the fourth company's value will also be around 10 crores. It's just like suppose you go to a particular area in your house and ask per square feet flat ka rate kya hai, and then you say 2-3 houses, then the fourth house ka rate will be also similar, unless it is made with a golden commode or golden tiles or something like that. If they have used the same type of tiles, same type of material, cement and other thing, etc., and constructed the house, the per square feet rate will be around that, maybe plus minus 5% either other, because of the design or the location or etc. So that is called comparable company analysis. One is dividend discount model, I'm going back. Then discount cash flow model, in which all the future cash flow the company will be generating. Cash flow is basically after profit after tax, you add back non-cash expenditure like depreciation, amortization, etc., and then you get the cash flow. And this you discount. And then the value you get is the present value of the future cash flows. So this is what you are ready to pay. Now, if the price is less, it is just like company paying, but it is used mostly in case of takeover, in case of when you want to merge two companies, when you want to demerge one company or spin off, or you want to segregate two companies. That time this method is very much used, discounted cash flow method, and of course comparable company analysis. And price to earning is a very simple way. Market may we use it very frequently because that's the quick way to get the price, expected price. Whenever the company is doing well, I told you in the earlier class that we can calculate the earning per share, and price to earning is nothing but price to earning per share. We'll come to it just after this. Oh, sorry. P ratio. So P ratio approach is a method valuing equity shares that compares the price of a stock to its earning per share. The P ratio is calculated by dividing current stock price by the EPS. So price is EPS and area. Now let us look at it. Suppose your earning P ratio of an industry is 30. P ratio of an industry is 30. Now you are also earning, and your multiple is also into 30. Your price, you are earning 30 rupees. Your earning per share 30 rupees. Multiply by 30, 900 will be your market price. But suppose I study that each quarter your sales is increasing. That will, in all probability, that will increase your profit. And I check after the 3 quarterly results comes out that yes, your profit is increasing. That means I can guesstimate annually your profit will increase, and since you are not issuing any shares now, your earning per share will increase. So maybe it will be 35. And if industry average remains 30, then 35 into 30, 1050 will be your share price. So it was 900 earlier, now 1050 will be your price. So roughly 20%, 18% I'll be gaining. So this is how the PE ratio is used by the investors, which are not doing much research in the market, but looking at some simple figure. भाई कंपनी कमाता क्या है, whether in बेचता कितना है. If it sales increases, probability is that its earnings also will increase. So you can focus on earning also. If its earning is increasing this year, the price so has to move up. The rationale behind this, because P ratio, see, if you multiply the earning per share, the price will be higher. So this is the beauty of the P ratio. Now let's go back a little bit. Dividend discount model. Now dividend discount model is something again like your debenture what we have driven, because you have purchased the security at a particular price, PO, or you want to know the PO. It can be anything. PO, suppose you have purchased and you are getting dividend D1, and your required return देके you are discounting it. So first is D1, then is D2, then 2 is to the power 2, then DN. So this is the model. Now, if the value of this is equal to PO, then your purchase price has been correct. But if the value is less, that means you have paid more, but you are in today's present value, you are getting less. So this is a very important part when you do the dividend discount model. So what we do generally, if a company, the problem with this model, I will come later on. Dividend do not grow in future. Sometimes companies reduce the dividend because they are into expansion phase or something like that. Dividend grows as a constant rate in future. This case is there in many cases, and dividend grow at varying rates in future. This case is also very. So every time, what will happen if you use this formula? This D1 and D2, these all will be different figures, except the constant. Their D will be fixed. So you can use this formula and find out the PO or the present value of your expected. Now the whole story is about expectations. If you're expecting the company is going to give 20% dividend, now dividend is given on the face value. So if the face value is 10 rupees, dividend is 20%, that means 2 rupees, and they will give next year 30, then 25, then 30, then 35, like that, then 2, 2.5, 3.5, like that will be your D1, D2, D3, like that. And then you will divide by your expected return. So suppose you expect 18% return from this company, or dividend paying company है 15% return होने से भी चलेगा, because dividend I am getting 2, so 15 plus 2 is 17. So that is how you divide it, and you get the present price of the share, current stock price of the share, and you are happy, or you are making a right decision as per your requirement. But all the three I have told you, this company can change over time. A company may or may not decide to give dividend because company has an expansion plan. Company can think of giving you bonus shares. Company can think of, okay, we need money, let's give them right shares at a lesser price than the market price. So that gap is your basically a dividend. Okay. I'll just tell you, Airtel, Bharati Airtel, from the date of its listing till 10 years, it didn't pay any dividend. But the price went on growing up to, from 42, they issued, it went up to 600 almost. then later on settled to 300 or 400, something like that. And now I do not know exactly, I'm not tracking. So this is how the dividend is called model. These are theoretically models are there. They work in ideal situation, but in real situation, you have to be very careful to take this data. Am I clear? Now let me again try once more if it is working. No, it's not working. Dividend growth model. The dividend growth model is a method of valuing equity shares that it take into account expected growth rate of the company's earnings and dividends. If the model is also known as Gordon's growth model or dividend growth model. Growth model assumes that value of a stock is equal to the present value of all expected future dividends. Can you, isn't it sounding the same like bonds or preference shares that I am giving the same amount of interest, the cash flow, or dividend, the cash flow in preference shares, or here the dividend, the cash flow. And if I do the present value, I'm sorry, in this growth model, I'm very sorry. In this growth model assumes the value of a stock is equal to the present value of expected future dividend. Here, what is happening? The dividend is growing at the rate of G or whatever it is. It's also incorporates a growth rate component. The formula for the growth model is PO, which is the current stock price. D1 is the next year dividend, but D is the dividend, D plus 1. G is the dividend growth, divided by R minus G. Next year dividend, expected next year dividend payment, it will be expected next year dividend, sorry, it is expected, D1 is expected next year dividend payment. D1 is expected next year dividend payment. R is your R is your required rate of return and G is expected dividend growth rate. So your expected return should be always more than the dividend growth rate ka return expectations. Otherwise, the formula will not work. The formula of growth model is PO. We can just in Tabranis, I could have given an example. If your last year dividend is 10 and you expect it to grow at the rate of 2%, then 10 plus 2, 12 will be the D1. And if your expected return is 8, then 0.08 minus 0.02, because 20%, 2% is the growth, 20% is the growth rate, and your return is 25%, so 0.25 minus 0.20. 0.25 minus 0.20 is 0.05, and upper me you have 0.02, you multiply, divide and multiply, solve for it, you will get the price at which price you will be buying the stock. So sometimes when you are following a company, I will not name it's a big aluminum company, they're a regular dividend payer, and if you can come to know that they are going to increase the dividend, then you can use this formula to guesstimate at what price if you buy, then you get your desired return because R is your desired return. Please remember this, R is your desired return. So if you know the last year company has given dividend X and this year company is going to give dividend of X point plus 10%, 20%, 30%. So you know the growth rate. You have an expected return. So you can always work out what price I can buy it. Now, if the market price is lesser than that, then buy it. Because company price will ultimately, when the company will declare the dividend, price will go up. So this is a very good way. A lot of people, they do make quick money when the dividend session comes in and companies start declaring dividend, or you are closer to the market. I told you market is efficient, inefficient, and weak form of market. That information do not flow to everybody in equal way. So if you're lucky that you are in the efficient market where information flows, but market is not reflecting it, not efficient market, semi-efficient market. You are privy to the information, but market is not privy to the share. Then what happens is that you can take the opportunity and buy the share, and that's how you will be getting the required return what you want. P ratio I have already explained. And the finally, so valuation of securities, let us sum it up for the session 2, or rather book 2, or unit 9. Valuation of securities is the process of determining the fair value of a financial asset, such as stock, bonds, and other investments. There are several methods of valuing securities, each with its own strength and weakness. We have discussed some because of lack of time. Some of the most common methods include DCF analysis, which calculates the present value of expected future cash flows, PE approach, which compares the stock price to its earning per share. Just now I was talking about, and dividend discount model. I just shared with you about some companies, leading aluminum company which does it. uh, Estimate the value of the stock based on the expected future dividend payment, and then you can calculate it for your expected return and get the price, and you check it with the current market price whether it is worth buying or it's not worth buying. And with this, we are coming to an end. Thank you very much and wish you all a happy new year. I hope 2026 will bring a good time for all of you. Thank you.